Hello traders, Nick here. Wanted to answer a few questions about what to do here. I had a debate today in the chat room. By the way, there's a link to the chat room down below if you're not already in there. Try it out. The concern is, oh my gosh, I don't want to miss out like last year. I think it's different than last year. This is the SPX. Let's go to a daily chart. So last year we were falling and deciding whether we should get long or not, or retest the lows or whatever. So people were calling for lows, and we said, no, stay long. Well, this is the exact opposite situation here, because we haven't had 2 red days in over a month. I think Christmas was the last 2 red days, or whatever. It's been a while. So what do? How do you get long without risking a lot? So options allows for that. So the question is, they have the fear of missing out, the FOMO everybody talks about, but they don't want to lay out a lot of. So it's hard to buy a stock way up here. It's really hard. I understand it. That's why the options have an alternative that is somewhat reasonable. I could just sit it out a few days. So what if I miss out a few pennies? I just have to train. Don't look at it. I have to train myself at it, ignoring it. But up here, it's definitely not an obvious place of entry. When it was falling, I had a thesis, and it was falling against my thesis, but I had conviction, so it's easy for me to say, wait it out, or start longs now, or something. But up here, it's exactly the opposite situation, so how can I do it? Well, the options market allows you to buy contracts on calls to bet on the upside prices. Most of you know what that is, so if you don't, so it's almost 3,400 on the SPX. So if I think by next week, the upside potential just today might be 3,400 and then some. And if that's the case, then 3,450 should be in sight. So 3,430 next week is doable. So I can buy a call spread. What does that mean? I buy a call, it costs a lot. But I buy I sell a call above it in the SPX for next week's contracts on Friday the 28th it expire. It's a bet. I'm buying a contract and selling a contract against it. The net effect is a debit of $1.20-ish. This is not a trade alert, by the way, but this is one way of going long without risking a lot of money. So if I risk $120 for that $1.20, because each contract will cost, you have to multiply by 100 because it represents 100 shares. So the total cost is $1.20, $120. That's the maximum I can lose. If it goes to zero, I only lose $120. What happens if it goes to $1 million? I want it to go through my legs. So if I bought the 34.25, 34.30, or 34.35, 34.40, depends on what call spread I buy. I need price to go through both sides to get my maximum win, which would be 3.8. How did I get that number? It's $5. That's the maximum width at the spread I bought. But I paid $1.20 for it, so I can't claim all of it profit. I paid $1.20. $5 is the max. Therefore, my total maximum win is 3.8. So that takes the itch off of me trying to get long with something, buying stock for $50,000 and then get stuck with it at the top, the very top of the market. I'm not saying this is the top. I'm just saying the person is fearing the top, so they're crippled. Their hands are tied. They have the FOMO. They're logical enough to say, I don't want to jump in. I want to see what happens. Sorry. So that would be one way to do it. A debit call spread. How does that work? I sell a call, 34.25, for example, on the SPX. I'm sorry, I buy it. So used to selling spreads. I buy a call, the 34.25, for example, and I sell the 34.30 above it call. That reduces my outlay. So if I'm really bullish, I don't sell the other one, but then I'm out hundreds of dollars versus just $120 because it costs a lot to buy a naked call. So if I do that, then I limit my maximum profit as well, but I am only risking $120. Now I can go to, so per contract. So if I wanted to do 10, I'm risking $1,200, but I can make $3,800. It all depends on personal preference. To me, $120 is nothing to laugh at. It's 2-3 times you get a car payment in, you get your groceries paid for that. So it's nobody should laugh at $120, but the upside is $380. And is it ideal to buy at all-time highs? No. Is it ideal to short at all-time highs? Also no. I need a reason to short. I don't short just because it's this high. Logically, I am a little bit short, but it's a tactical move, and I'm okay with it. I was long before, so washing it out, it's almost even. I'm also long some other stuff that is kind of short markets by being long gold, for example, and along some TLT, the bonds. So, but to take the itch off of doing something big and spending $50,000 buying a full position in a stock, I can bet upside on the whole market with just a few $100s spent in the options world. So this is the SPX. I can do the same with the SPY. They'll be cheaper. The contracts are cheaper for the SPY just because it's 10 times less. The ETF is, SPY is the ETF. SPX is the index, the cash index. So the SPX is a lot more expensive. So when you go to the options contracts to buy them, they cost a lot of money, where these guys are a lot cheaper. So if somebody wants to bet absolutes by buying calls and not call spreads, it's a little more, I can chew on it a little easier by using the SPY. But know this, that if I buy calls and then the markets fall, the premiums disappear, unlike buying stocks. So when I buy a stock and the stock falls, I don't have a time limit on that. I can sit on it for a long time. People who bought NVIDIA at 290 and then it fell to 130, 127, whatever it fell to. If they totally believed in the stock, all they had to do is just sit on it. There was no time limit. People that bought call in NVIDIA at 290, they got decimated. Their calls expired, worthless. So that's the difference. So, but they spent a lot less than having bought the stock. So this is where personal preference comes in. If I've got everything in stocks, why not dabble in options like that? I mean, I'm not risking a lot. The options get risky when people go crazy. They find something and they think it's the fountain of youth, and they jump in, and before you know it, boom, accounts are blown up. So, but in this case, if I put one trade with a limit of $120 risk per contract, it's a finite amount of risk that keeps me out of spending $50,000 to get into a stock just because I have a FOMO. Hopefully that makes sense. Again, this is not a recommendation to buy the upside for next week. But markets, I've never seen such bullishness from everybody. Nobody sees anything going wrong. Meanwhile, we have so much going wrong. I'm not saying that this is a cause for concern, but I find it strange that when everything was going, just a few months ago when markets were so much lower, everybody thought the disaster is coming. But now that it's up in the air, in the stratosphere, now nobody sees anything wrong. So it's a little bit strange. But they are buying the dips. So if perma bears, there are a lot of people that just like to short, and that's fine. You need both sides to win. But when markets are this bullish, not every little dip is the start of something nasty. There is nothing nasty coming. If anything, we'll just have another dip, and then they will buy it. We need new information in order to get something nasty. Like, I don't know, the coronavirus being 15-20% kill rate, and they're lying to us. That's one example. I don't know. I know nothing about it. So that's the unknown that could come out. Basically, black swan, and you can't invest on black swans. I mean, it can happen at any point in time, virus or not. It could be anything. It could be a erroneous trade somewhere, some T-VIX blowing up somewhere. You remember the VIXy, whatever, that everybody was shorting, and then one day it blew up and it disappeared and broke apart a whole bunch of investment houses. So problems come out of nowhere, but you can't plan for them. You just have to trade properly, as if they're never going to come. Nick signing out.